Seoul's Finance Minister Hong Nam-gi says South Korea will go ahead with its plan to levy capital gains taxes on cryptocurrencies like Bitcoin.
If you're a crypto fan, you should probably know that South Korea plans to impose 20% income tax on crypto transactions very soon. So people living in that country need to think twice before making any notable crypto transactions this year. The crypto fever. But before we discuss South Korean crypto laws, let's go over what the crypto fever is all about. If you didn't already know, cryptocurrency is decentralized digital money, based on blockchain technology. You may be familiar with the most popular versions, Bitcoin and Ethereum. But there are more than 5,000 different cryptocurrencies in circulation right now. And if you're wondering what you can buy with crypto, the answer is simple. Literally everything. Cryptocurrency can be used to buy regular goods and services. Although many people invest in cryptocurrencies as they would in other assets, like stocks or precious metals. While cryptocurrency is a novel and exciting asset class, purchasing it can be risky, as you must take on a fair amount of research to fully understand how each system works. A cryptocurrency is a medium of exchange that is digital, encrypted, and decentralized. Unlike the US dollar or the euro, there is no central authority that manages and maintains the value of the cryptocurrency. Instead, these tasks are broadly distributed among a cryptocurrency's users via the internet. The cryptographic proof comes in the form of transactions that are verified and recorded in the form of a program called a blockchain. A blockchain is an open, distributed ledger that records transactions in code. In practice, it's a little like a checkbook that's distributed across countless computers around the world. Transactions are recorded in blocks that are then linked together on a chain of previous cryptocurrency transactions. With a blockchain, everyone who uses a cryptocurrency has their own copy of this book to create a unified transaction record. Software logs each new transaction as it happens, and every copy of the blockchain is updated simultaneously with new information, keeping all records identical and accurate. To prevent fraud, each transaction is checked using one of the two main validation techniques, proof of work or proof of stake. These techniques are meant to make your transactions as secure as possible. Advantages and disadvantages of cryptocurrency. Cryptocurrency can have a range of benefits for you. These currencies essentially hold the promise of making it easier to transfer funds directly between two parties, without the need for a trusted third party like a bank or a credit card company. These transfers are secured by the use of public keys and private keys and different forms of incentive systems, like proof of work or proof of stake. In modern cryptocurrency systems, a user's account address has a public key, while the private key is known only to the owner and is used to sign transactions. This account address is known as a wallet, and fund transfers are completed with minimal processing fees, allowing users to avoid the steep fees charged by banks and financial institutions for wire transfers. Some disadvantages of the currency include the semi-anonymous nature of cryptocurrency transactions. This makes them well-suited for a host of illegal activities, such as money laundering and tax evasion. But you don't have to worry too much because cryptocurrency advocates often highly value their anonymity, citing benefits of privacy, like protection for whistleblowers or activists living under repressive governments. Also, some cryptocurrencies are more private than others. An example is Bitcoin, for instance, which is a relatively poor choice for conducting illegal business online, since the forensic analysis of the Bitcoin blockchain has helped authorities arrest and prosecute criminals. How do crypto transactions work? South Korea currently wants to impose taxes on crypto transactions. But how do these transactions work? And how are taxes imposed on them? Working with crypto coins requires having access to the public and private keys associated with that amount of coin that you have. When we talk about someone's crypto coins, what we actually mean is that person has access to a key pair, comprised of a public key to which some amount of coin was previously sent, and the corresponding unique private key, which authorizes the crypto coin previously sent to the public key to be sent elsewhere. If you didn't already know, public keys, also called Bitcoin addresses, are random sequences of letters and numbers that function similarly to an email address or a social media site username. They are public, so you are safe sharing it with others. In fact, you must give your crypto address to others whenever you want them to send you coins. The private key is another sequence of letters and numbers. But it's important to remember that private keys like passwords to email or other accounts are to be kept secret. You should not share your private key with anyone that you do not trust to not steal from you, ever. Also, remember to keep backup private keys with pen and paper and store them somewhere safe. So this means that your coin address is basically a transparent safe. Others can see what's inside, but only those with a private key can unlock the safe to access the funds within. South Korea to impose a 20% income tax on crypto transactions. As you might have heard before, officials in South Korea have announced their intention to tax crypto transactions to the tune of 20% starting next year. This means that in the beginning of the 2022 tax year, stock and bond investors will be taxed on capital gains that are over 50 million won, or $45,000. Non-sales transfers of crypto asset ownership will also be subject to statutory gift and inheritance tax rates of up to 50%. Even though this law has received lots of backlash and requests for a delay by South Korean investors, the taxation will move forward as planned. Many investors' complaints are why crypto is being singled out and why these new taxation rates are not imposed on stock market transactions as well. And even though that is a valid argument, the South Korean government does not care for any dissenters. So even though crypto investors are against the move, a study showed the citizens of South Korea in general support the new tax. The plan was originally announced earlier in the year during a vice-ministerial interagency meeting. The meeting was overseen by the head of government policy coordination, Koo Yoon-chol. Under the new regulations, gains from crypto transactions will now be deemed miscellaneous income and be subject to the new tax rate. This means that investors must report virtual asset gains when filing income taxes in May 2023. Government officials have also made the call to extend its Financial Services Commission (FSC) efforts to clamp down on illegal or illicit activities in the crypto market until the end of September. And so far, 676 people have been accused of tax evasion and saw their digital assets seized by Seoul authorities. In total, the group accounted for 27.8 trillion won, or $25 billion, of South Korea's tax gap. As part of the crackdown, crypto exchanges falling under South Korea's jurisdiction will be required to share trade and transaction records. You might not be aware of this, but the crypto tax plan has been in motion for months. And while many South Korean digital investors are up in arms about the news, it should come as no surprise to them because it's been going around for a while. The Korean finance minister also doubled down on his stance that virtual assets cannot be recognized as currency, and that no one can ensure the currently traded market value of virtual assets.
Crypto, under Korean law, is neither a currency nor a financial asset.
And under current Korean tax law, the government taxes profits from intangible assets such as trademark rights. Cryptocurrency assets are also labeled as intangible assets under global accounting regulations. The Korean finance minister went on to say that digital currencies are mere virtual assets and therefore have zero intrinsic value. And the taxation is not the only move South Korean authorities have planned. In fact, the FSC is also planning to restrict crypto-adjacent business operators from making transactions using their companies. The idea is to mitigate the chances that price manipulation and unfair activities become larger issues than they already are. The FSC reports that the number of companies that fall under this restriction is around 60. And the Korean government has also decided that gains from cryptocurrency transactions will be classified as miscellaneous income and will be subject to a 20% tax starting next year. Virtual asset gains must be reported when filing for general income taxes in May 2023. The Financial Service Commission, which is the nation's financial regulator, was also designated as the top government office tasked with overseeing and regulating the virtual asset market. The Science Ministry was chosen to handle the promotion and growth of the related blockchain industry. In any case, it isn't a great time to be a crypto owner in South Korea. Let us know in the comment section below what you think of the clues and information gathered up till now. Make sure to give this video a thumbs up and subscribe to our channel for more videos. See you in the next one.